You have been told crypto is decentralized, and technically, that is true. No single government owns Bitcoin, no single bank controls it, but there are wallets right now holding so much Bitcoin that if they sold, they would crash the entire market by 30% in a single day. Let's start with the whales. In crypto, a whale is anyone holding a large enough position to move the market. For Bitcoin, that's generally considered to be wallets holding 1,000 Bitcoin or more. According to blockchain analytics, roughly 2,000 wallets control over 40% of all circulating Bitcoin. Let that number sit with you. These are not random people. These are early miners, venture capital funds, hedge funds, exchanges, and institutions. And when they move, the market moves with them. There's an entire field of blockchain analysis, companies like Glassnode, Arkham Intelligence, Chain Analysis, dedicated to tracking large wallets movement because those movements often precede significant price action in the market. Here is how the game works at the retail level. A pattern called the stop pond or liquidity grab. It happens regularly in the crypto market, where large players identify where small investors have placed their stop loss orders. The price point at which they will automatically sell to cut losses. Then they push the price down to those levels, triggering those sell orders, collecting the bitcoins being sold at low prices, and then pushing the price back up. The small investors sold at the bottom. The whales bought at the bottom. This isn't any conspiracy, it is a documented behavior. Exchanges themselves have also been implicated. Binance, one of the world's largest crypto exchange, has faced multiple regulatory investigations across jurisdictions. Its founder, Changpeng Zhao, also known as CZ, pleaded guilty to violating US anti-money laundering laws in November 2023 and was sentenced to 4 months in prison. Binance paid a $4.3 billion settlement to the US Department of Justice, and yet it remains the largest exchange by volume in the world. Tether is another major piece of this. Tether, the company that issues USDT, the world's most used stablecoin, has never completed a full independent audit of its reserve. Their claim is that every USDT in circulation is backed by a real US dollar. Critics, including multiple university researchers, have published papers suggesting that Tether was used to artificially inflate Bitcoin's price during the 2017 bull run. In New York, the Attorney General found that Tether's parent company, Bitfinex, had hidden an $850 million loss and lied about it. This was settled in 2021. No criminal charges were filed. Tether continues to operate. I say all this not to scare you away from crypto, but because understanding who is playing the game is the only way you play it without being the one who loses. Now let's talk about the most important mechanism built into Bitcoin, the halving. Every 210,000 blocks mined, which works out to roughly every 4 years, the reward that Bitcoin miners receive for processing transactions is cut in half. This is called the halving. It is hard-coded into Bitcoin's protocol. It was designed by Satoshi to control inflation and ensure that Bitcoin is issued at a decreasing rate until all 21 million have been mined. Here is why this matters for price. The halving directly reduces the new supply of Bitcoin entering circulation. Less supply, same demand. Basic economics says that price should go up, and historically, that is exactly what has happened. The first halving in November 2012, Bitcoin was around $12 within 12 months, and it hit $1,000. The second halving was July 2016, but Bitcoin was around $650. Within 18 months, it hit $20,000. The third halving was May 2020. Bitcoin was around $8,000. Within 18 months, it hit $69,000. The fourth halving occurred in April 2024. Bitcoin was around $65,000 at that time. What happened next is something the whole market is watching. The halving alone doesn't cause bull runs, but it creates the supply condition that, combined with the increasing demand, have historically driven explosive price appreciation. This is the clock that serious investors track. Now, let's talk about the new players that changed everything in 2024. In January 2024, the US Securities and Exchange Commission approved the first Bitcoin Spot ETF, a product that allows traditional investors to gain exposure to Bitcoin without actually holding it. The players who launched these ETFs, BlackRock's, Fidelity, Invesco, the biggest asset managers in the world. BlackRock's Bitcoin ETF, the ticker IBIT, became the fastest growing ETF in history, gathering over $10 billion in assets in its first 49 days. Never been done before in any asset class. This wasn't retail investors. This was pension funds, endowments, sovereign wealth funds, institutional money flowing into Bitcoin for the first time through a regulated structure. MicroStrategy, renamed as Strategy, now holds over 800,000 Bitcoin in its corporate balance sheet. Michael Saylor has essentially turned a software company into a Bitcoin holding vehicle. Multiple other publicly traded companies have started following this model. El Salvador, under President Nayib Bukele, made Bitcoin a legal tender in 2021, the first country in history to do so. They've been buying Bitcoin consistently since. Their national Bitcoin wallet is currently in significant profit. And then there is Africa. Nigeria consistently ranks in the top three countries globally for P2P Bitcoin trading volume, according to analytics from China Analysis. In 2021, Nigeria Central Bank banned commercial banks from servicing crypto companies. The result, Nigerians moved to P2P trading and used crypto more than ever. The ban was eventually reversed in 2023. What happened in Nigeria showed the world that you cannot ban an idea whose time has come. The hidden game is real, the manipulation is real, but so is the structural adoption that is happening right now at every level. From individual Nigerians protecting their savings from Naira devaluation to American pension funds buying Bitcoin ETFs, the two things that coexist. The last episode of this series will answer the question everyone wants to be answered. Where does this all go from here? So I'll see you in the next episode. Do well to subscribe to this channel. See you there. Ciao.